You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And welcome to another episode of A Smarter Way Home. We have modern mortgage strategies for both consumers and real estate professionals alike. I am your host, Victor Bals, licensed loan officer, about 22 years now. And I want to introduce my co-host, my co-hostess with the mostest, Mrs. Danielle Boote. How are we this morning?
I'm doing fabulous, Victor. How are you?
Well, I am. You are doing a lot better than I am. I am stuck here in Detroit with 38 degrees, windy, rainy, and you are where, Danielle? Tell our consumers.
I am in sunny Cape Coral, Florida.
And what are you doing down there?
Jim and I are down here with our daughter, just kind of relaxing for a couple of weeks. We're also doing some digging because we bought a piece of property down here.
You bought a piece of property in your building?
We're going to build a house, a vacation home for our family.
Wow. And with these real estate prices going up like crazy, I'm hearing a lot of consumers saying, I don't want to build, it's too crazy. Prices are too high. Well, Danielle, you've been in this business about 32 years, yet you are making the decision to build and buy down in Florida. Let's look at the mental notes that you're making. What made you make that decision?
Well, we were down here in October for a vacation. We've been coming down to this area about 3 years. We really love the area. And our family loves to vacation with us. We have 4 adult children. We have 2 son-in-laws and 2 grandchildren already. And if I call them and say, hey, we're going to Florida, do you want to join us? If they can, they will be here. And as they've been adults, it's hard as your kids get older. But it's really awesome if you can spend a week with them on vacation, one-on-one with their families. So the problem that we have as a big family is where do you go when you have 10 people? I'm going to have to move my computer here. The sun is moving on me here, so I'm going to...
Oh, yeah. Rub it in, will you?
Yeah, I don't know. How do we do this? How do we do this without having a ton of glare?
Yeah.
I apologize. Okay, let's try this maybe. I don't know.
Okay. Oh, Dale, you look fine. Go ahead. So go ahead.
So Jim and I decided, we were kind of looking at values down here and thought, do we buy something? And houses were selling incredibly fast in this market. Home values have gone up in Florida and in the Cape Coral area 25% in the last year or two. So we kind of got this crazy idea that why don't we buy a piece of property, because they're not making any more waterfront for the most part down here. And we'll see where that leads us. So we're interviewing builders right now and kind of just getting our ducks in a row to see what the opportunities are. Because in this market, even with prices this crazy, we can build down here, obviously get a brand new house and all the benefits of a brand new house for cheaper than what we would buy in an existing market.
Okay.
As long as we're willing to be patient and wait.
And you and I being in this industry, we're seeing these inflationary rates or these, let's just say this appreciation going up so fast. Sometimes it concerns me like, oh my God, should I pull the trigger? But yet you went ahead and pulled the trigger. So something must make you feel comfortable in the marketplace of making that decision to jump off that bridge and build a house in Florida, 1,000 miles away.
Correct. Well, it is kind of crazy. Like if you would have asked me 5 years ago, I would have never thought that I would even be interested in owning a place in Florida. But I kind of look at it, not that I plan on retiring anytime soon, but Jim is retired. And we kind of looked at it and said, what are we going to wait for? Are we going to wait 5 or 10 years? When, and we're not going to leave Michigan full time. But we also have business opportunities down here. So I personally have been licensed in Florida for many years. We do a fair amount of business down here. So I also look at it as an opportunity to continue to grow our branch.
opportunity to have a branch down there in Cape Coral, Fort Myers area. Well, that would
Maybe,
be
yeah.
very interesting. And I tell you what,
Yeah,
you hit
because there's a lot of Michigan folks. I mean, down here
yeah.
that
Yeah.
there's a lot. It's
Oh,
amazing. We met a couple yesterday that they live in Maine. This is kind of a melting pot of people from all over the United States. The people that we're renting a house, the people that own this house live in California.
wow.
You know,
Interesting.
the house we rented in October, somebody owns from Indiana. So that
Well, I
people
could,
are all over down here.
well,
But
I
it's kind of
can,
eternal summer.
yeah, well, you know what? You can almost guarantee, you always want your kids to come home. There's two ways kids come home, and that's money or we're going on vacation. At least you'll know they'll come and see you down in Florida, so.
Yeah, yeah. So we're going the vacation route. Luckily, our children are doing well in life and established, and you know. But I look at it, as almost a legacy situation. I would rather enjoy a second home with my family now than not to be gone in 30 years and
Right, right, right.
leaving a vacant house.
Absolutely. Hey, so
Let's make the memories now.
absolutely. So let's talk about pricing on second homes. So when a consumer buys a second home, it's just like buying your first home on the interest rates and all that. But recently, Fannie Mae and Freddie Mac have put an adjustment or an additional cost on there to do second homes. One, why do you think Fannie and Freddie had done that? And what's the purpose of that? Because we've seen this
Well,
kind of adjustment back when the pandemic come in, and now
yes.
it seems like this is repeating. So please explain that to our audience.
So let's discuss what's required to purchase a second home. Loan program wise, you will be in a conventional mortgage with a minimum of 10% down. And there are rules in regards to a second home and what qualifies as a second home. The rule of thumb is that it should be at least 50 miles away from your primary residence, and it should have recreational properties. So if you're in Michigan, a lakefront home could be certainly recreational. A property up north on acreage is also very popular in northern Michigan. All of those things would apply as a second home. You cannot buy a house down the street from your primary residence and call it a second home. Okay.
Because it's too close.
It's too close. Now, there is a variance to that 50-mile rule if it makes sense when we look at the situation. So, for instance, our first second home purchase was only, 10, 15 minutes from our primary residence, but it's a tiny cottage on a lake. So it makes sense that it's a second home because it's not big enough for my family to live in full time. And it completely has recreational use. So in our market, as an example, you could live in Ann Arbor and buy a second home in the Pinckney area on the chain of lakes, and that would be okay. Okay. So those are the guidelines that, basic structure that we're looking for a loan. Now, in regards to pricing adjustment factors, now these are changes that have come down from Fannie Mae. They do apply to all loans that will close after April 1st, 2022. And basically what Fannie Mae is saying is that, hey, if you're going to buy a second home, we're going to charge you more money on an interest rate. Okay. And you're correct, Vic, that we did see a pricing change about a year and a half ago. Fannie Mae pulled back on it in the fall and said that a second home is the same as your primary residence. Now the second home is going to be higher in rate than the primary residence. Why do I think this is happening? I think a couple of things. Second home purchasing has been very strong the last few years. One of the reasons I think it's strong is that people are probably seasonally renting some of their second homes, even if they intend to use it for their family because of VRBO, Airbnbs, they're renting out these homes, making them a higher risk to Fannie Mae, and Fannie Mae is concerned about that.
Well, I think, and I agree there, but I think it's another reason because of our inventory problem that we have.
Mhm.
Because if an individual buys a second home, when an individual goes and buys a home and sells a home, they're taking one off the market and they're replacing one onto the market. However, these
Mhm.
people buying second homes are only taking one off the market. Do you think the mentality is there for Fannie and Freddie to say, hey, okay, you're going to pay a premium with a second home because we want this to go to first-time home buyers in that? Do you think there's any merit to that thought process at all?
It could be a little bit, but I think it's just based on
Risk factors?
risk factors. I wanted to say corporate greed.
Yeah, they
Let,
just
let's
want more.
let's be honest. I mean, the things that Fannie Mae looks at, that they look at loan performance long term. So the reason that there are pricing adjustment factors when getting a mortgage have to do, for instance, with your credit score, your down payment amount. They know that people with a higher credit score or a larger down payment generally perform better over the long haul.
Hmm.
So they're trying to slow down um, the market. Let me see if I can do a screen share here.
Okay.
Okay, let's try this.
So we're going to do a screen share, or what are we going to do? Look at the pricing adjustments?
Well, I'm gonna try to show you the pricing adjustment factors.
Yeah. And as you're bringing up that screen, let's just talk about interest rates here and what has happened over the last couple months. Because when we were at the beginning of January, basically rates were down at that 3.25% on a 30-year fix, APRs there.
Mhm,
And
mhm.
now we're at the end of March and we are approaching 5% on some of these. And we've had
It,
quite a jump
which is
here.
yeah, which is a huge jump. Can you see my screen at all, Vic?
No, I cannot see the screen at all.
Okay.
So,
Well, I'm not gonna play with it then because I don't
okay.
know how all this
Well,
technology
let's
works. But
let,
but in a nutshell, on a second home, Fannie Mae is gonna charge 4.125 basically discount points.
and put that into
It
perspective, but make that an understanding to our consumers on some numbers. Let's say a $300,000 loan. That's over $12,000 in discount points that they're going to bring to the closing table, or we are
correct.
going to raise their interest rate to cover that.
Correct. Or a combination of both. Like we actually had a client this week, one of our loan officers, kind of an interesting situation. Client was buying a second home. They're getting hit with these pricing adjustment factors. And when the loan officer tried to lock the loan without charging points, the rate was so high that it caused a federal violation and threw the loan into the high priced
Uh-huh.
mortgage bucket, which means we couldn't even disclose. So we had to. It took us a little while to play with this loan with corporate and compliance to say, okay, what can we charge for the rate and what can we charge for points to make this loan work? And
Mm-hmm.
without getting too technical, there are high price mortgage limit rules that the Dodd-Frank Act enacted many years ago, trying to protect consumers so that lenders don't charge too much because we are capped at what a lender can make on revenue. We can't charge too high of a rate for somebody. So, in the scenario where we have these pricing adjustment factors, it was difficult, very, very difficult to price this loan to give the consumer a decent rate and a decent fee structure. Now, when the government is measuring this high price mortgage limit, the problem is they're looking at the last quarter's rates. So we're looking at a threshold from December, and with rates went up so much since January that the December numbers don't make any sense to the computer. And they go, well, the rates can't be that high.
Uh-huh.
We
Uh-huh.
can't be charging somebody over 5% when last year they were under 3. So we will see some of that issue shift.
And this is across the
Hopefully, once
nation?
we roll.
This is
Yes,
across
this
the
is across
nation?
the nation. All lenders have the same problem. So I do know from calling corporate that they had several loan officers that were trying to price second homes and running into this issue with pricing loans. So it could cause some lenders to stop doing second homes. The
Mhm.
other thing that we did see in the last 18 months was that what we would call non-QM lenders will come out with lending programs targeted at this product that
Explain what
might be a
a
better option than
explain
Fannie
what a
Mae.
non-QM is to our consumers and our real estate individuals.
Non-QM is what is called a non-qualified mortgage and is a loan that is not heavily regulated by the government agency programs such as Fannie Mae and Freddie Mac. It's
Okay,
more
and
of
that's
what we would call a portfolio program.
okay. And on those portfolio programs here, so now is the pricing somewhat different in some cases then?
In some cases, it can be higher. In some cases, it can actually be better.
So
What we
now,
ran into in the last 2 years was that some of the non-QM options were better than Fannie Mae because those banks basically said, hey, we understand that there's a need for this lending program. We're willing to take the risk on it because we think the return is going to be strong.
right now, do you recall what the Dodd-Frank rule was? Wasn't it, if I remember correctly, wasn't it 3%? That the loan cost cannot be more than 3% of the loan amount. So on a $300,000 loan, all points, cost, and all that cannot exceed $9,000, else you are not in a qualified mortgage. You are now in a non-QM, non-qualified mortgage.
Right. It does not include all closing fees, just what the lender is charging.
Okay, so
Just
now,
a simplified version of what that rule is. It's very confusing. But what's going to happen and what typically has happened historically, I'm not going to say that the government regulation is bad in and of itself. It was written to try to protect people after the crash happened in '08, but it will ultimately limit lending. And I think right now, when you look at, let's talk about the inflationary pressures, the government right now and the Treasury is going to try to slow down the economy because it's moving too fast, and they're going to try to check inflation, which inflation is the enemy of the mortgage bond market, which we've talked about recently. Due to the inflation that we're seeing right now, that's why we are seeing rates go up so high, so quickly. And to give you a perspective, we keep hearing on the news that, inflation is at a 40-year high. Well, what was 40 years ago? The early 1980s. In
right?
the early 1980s, we had mortgage interest rates that were between 12 and 18%. We did not get out of double-digit interest rates in mortgages until 1990s.
Yeah, yeah, that's very
Even
interesting.
1990, we were like at 10.5%.
Yeah, so and then back in the 80s, we had 18% interest rates. So what they did, and people, please remember, your mortgage interest rates are different than the Fed's rates or the prime rate. And when they raise that prime rate, this doesn't necessarily mean mortgage rates are going up. What this means is this is short-term lending where mortgage rates are generally long-term, 10, 15, 20, 30-year terms here. And so by the Feds raising the prime rate, that's short-term lending for credit cards, cars, business to business. That tends to slow down.
Equity loans.
Yeah, home equity loans. That tends to slow down the economy, and when we slow down inflation, and when we slow down inflation, drives mortgage interest rates down. So in the 80s, when the interest rates were 18, the Federal Reserve raised the prime rate. I believe it was from 12%. It was at 12% at the time, up to 20%. On the short term, on the prime rate lending, and that drove interest rates down from 18% down to 12%. And this cycle is repeated through every recession we've seen here. And I don't know if we want to go down that rabbit hole and what we see here in the near future, but just to give the people example of what the prime rate does. And my indication is the Feds are not raising the prime rate fast enough. And they're talking, 5 to 7 more rate increases this year?
Correct. So they did just raise the prime lending rate 0.25% this month in March. They wanted to raise it 0.5%, but because of the issue in Russia and the Ukraine, they actually held back a little bit. But they're now already saying that, nope, we're going to have to go up 0.5% in March, or I'm sorry, in April at the next Fed meeting.
It's funny because we speak of Ukraine, how sad that is. But I was doing a little bit of research, and did you know? Because we're always talking about our supply chain. What's going to happen to our supply chains and all that stuff. Did you know that Ukraine is the #1 exporter of neon gas? Did you know that?
I heard that. Yeah, I did hear that recently also, and wheat.
Yeah,
They are
but
one of the world's largest growers of wheat,
and
and they
barley
sell all
and
over the
barley.
world. And
But
barley, uh-oh, we
you
know what
know,
that's going to impact.
yeah, yeah, my beef barley soup, the only soup I like, So, but anyway, we talk about neon gas, and everybody thinks back from the 70s, oh, all the neon signs and all that. But, well, let's
Mhm.
take out all those. Did you guys realize that neon gas is one of the elements needed to manufacture semiconductors, and semiconductors are the things in your cars, all those chips? So we think we got
Mhm.
a supply chain. If this Ukraine war goes a little heavier or a little deeper here, this could affect that supply chain, which is already hurting.
Absolutely. I also believe that they use neon gas in medical devices.
Yeah, yeah. So this,
And I'm not going to paraphrase that exactly correctly, and I didn't research this, but they use neon gas for like a testing machine for healthcare purposes as well.
yeah. So we don't know where this is gonna go, but this is going to have a effect on our economy, right? We've got mortgage interest rates having an effect on our economy. We've got inflation having an effect on our economy. So we've got some elements there. Nobody's got that crystal ball, but from the financial circles you and I are running in, it looks like we potentially have a recession on the horizon. What is your thoughts about that, Danielle?
Well, that is definitely, we've heard Barry Habib. Usually, you and I listen to Barry Habib every day when we get his morning update. He's been talking about this for a while. And, there are indicators that the economists watch
Yeah.
to be able to predict when a recession is going to happen. Now, a recession in itself is not a terrible thing. It is sometimes by the time we know we were in a recession, we're already on the way out.
Hmm.
But it definitely does appear to be looming. Why don't you explain what the economists are looking at between the 10-year yield curve and the 2-year margin?
Well, that's a rabbit hole. But what I was doing this a little bit of just reading yesterday and all that. And one of the indicators that we are going into a recession is when the 10-year Treasury bill and the 2-year T bill, when they invert. There's an invertive curve there, and that's a true indication that we are going into a recession. Also, Barry went on to say, he goes, you look at the unemployment rate. We are very low on the unemployment rate. He goes, an indicator that we're going to go in the recession is when the unemployment rate bottoms out, and we're near that right now. And then all of a sudden it starts to peak up a little bit. That's an early sign that we've got a recession coming in the next 6 months. And so we are so close to those curves being inverted. We are so close to bottoming out on that inflation. Or on that unemployment. And we've got this inflationary jitters. All the signs are there that we are going to have a recession. He also talked about the fake news of the media, because they're saying home sales were down 1% last month, year over year. Well, the reason the home sales are down is because there's just no supply. There's nothing to buy.
Right.
It's supply and demand. And when we see prices, it's just simply supply and demand. If we have prices continually appreciating, that means there's not enough supply. People can't find houses, and we can't build them
And
quick enough.
the builders numbers also came out federally for January and February, and they said the same thing. They're like, well, builder starts are down. Well, it doesn't mean that there's not demand, but is there land to build on? How long is it taking for permits? Like in Florida here, most builders are telling me that it will be an 18-month to 24-month
Whoa,
project to
whoa,
build a house. Permitting down here is very expensive, and it will take 6 months just to get permits to build a
wow,
house.
wow.
That's
Because
after you get, for instance, to the blueprint stage. So, um, there's a lot of issues why it's hard to buy a house, build a house nationwide, and why the builders can't keep up. They don't have trades that are
right,
ready and available to work. They do not have that. There are supply chain issues. There was, in Florida, for instance, they build their homes out of concrete block, and there has been a concrete shortage. If they can't make the block, there's a house down the street from us. The foundation has been poured. The footings are in. The trusses are on site.
uh huh.
There's no workers. There's no concrete block. So
Wow.
until the block gets delivered, they can't start building this house.
Well,
And there's been lumber shortages too nationwide. So it's not that there isn't a desire. I think right now, I mean, what do you think your average is, Vic, with your clients? Right now, we are super busy with pre-approvals.
oh God, yeah.
We're also calling all of the people that we pre-approved last summer to say, did you buy? Are you still looking? The answer that we're getting from most people are, we're still looking. Can we
Yep.
update our pre-approval? So we are updating all of these pre-approvals right now. I think right now, I personally have 5 pre-approvals coming in a week and maybe one person buying.
Yeah.
5.
Yeah.
5-to-1 ratio of somebody actually going in contract. And the people that we pre-approved last summer at maybe 3%, 3.125%, 3.25%, are now
Yeah.
going to have to adjust to interest rates in the high 4s to the low 5s. That's
And
a huge
I've
increase.
been making those. I've been putting my tail between my legs and making those calls because I'll email clients, hey, you still active? Yeah, but there's nothing on the market. Yeah, there's nothing on the market. And I too last weekend shot out 5 pre-approvals and not one of those offers got accepted, and these people are, about ready to throw in the towel. And I say, hey, just you can't hit them if you don't swing, But as I'm going through my clients there, I'm saying, we should probably have a discussion and let's talk about the market. The market is up near that 5% level, and give them that shock factor now and rerun those numbers, update the credit, get updated income and asset documents. So when we do, because what's going to happen? No, we're just going to hold for now. And all of a sudden it's Friday night. Oh my God, we found the home. We got to get an offer in right now. We need to have those updated documents for our highest probability of getting an accepted offer, because we know these listing agents are going to be calling and confirming we've verified everything.
Right. It's very, very important. We need a solid deal. And unfortunately, with rates going up, it might take some buyers out of the market, but it's not going to take many out of the market. And I think it's actually causing the buyers to even be more motivated because they want a house before they go up higher.
Yeah, they were panic buying before. Now they're even more panicked. They want to buy before rates even go up higher. So,
Yes.
But you made a good point that it's going to take some of these home buyers out of the market, but that's only going to be temporary. That may be for a month or two, and then they're going to get used to the higher rates. And remember, our interest rates at this 4.75 to 5%, we are only back to pre-pandemic levels. These are where rates were just 2.5 years ago. So we're coming back more into a normal market. Everybody just got spoiled by the pandemic and the low rates. But now we're, and let's talk on that because of affordability here. And I ran some numbers the other day, and, we had almost, we're approaching almost a 2% gain in interest rates. And just to put this in perspective, people, when we take a $300,000 loan and you add 2% to that rate, that's $6,000 a year. That's $500 a month less that you can afford now, okay, on that $300,000 loan. So if you're sitting there waiting for rates to come down or waiting for the market to crash, I personally believe people are waiting themselves right into the poorhouse here.
Yeah,
It is time to buy.
I think it's more important to buy right now and know that when rates come down, it's not when rates come down, it's when they come down.
You made it right. It's not if, it's when.
We'll refinance you and get you a lower rate.
Right.
But at least you have the house. If you don't have a house, it doesn't matter. I mean, if rates are low and you still can't get a house, you still don't have a house.
Yeah, absolutely. So
you're talking figure out what
objective
your budget
conscious. Yeah, you're talking objective conscious, people. And if you want a house, let's meet that objective. And we are going to get you the best rate on the market at that particular time to execute that particular offer under that particular situation. And then as life goes on, if there's an opportunity to better your situation, we're gonna have your back. We got you.
Exactly. And the other thing that I think is going to be more commonplace that consumers and even realtors need to be aware of is that typically as a loan officer, I do not want to charge discount points.
Right.
Okay. I am typically going to quote a rate with standard closing fees, little or no points. That is, I think, something that's going to shift into 2022 here, because buyers are going to look at it and say, well, hey, if I can get a slightly lower rate, I'm willing to pay points. And because of these loan pricing adjustment factors from Fannie Mae on, for instance, second homes, investment properties, the lenders are going to have to charge points. So that's not entirely a bad thing if it's what it takes for you to be able to purchase the property. So we're going to see more of that, I think, in 2022 as well.
And I think the people that are highly qualified may even take the opportunity, knowing that potentially we've got a recession coming and that there will be a rate drop, is these particular individuals may say, you know what, I'm not going to buy out a PMI insurance. I'm not going to pay discount points. I may even favor having the lender raise the interest rate a little bit and pay for that client's cost, waiting for the inevitable interest rate drop. And generally, when a lender pays for a refinance or you take a higher rate, it's generally 3-4 years. So, but I personally believe we will have a rate drop over the next couple years here. So it may make sense to consider paying a higher rate and having the lender pay all the closing cost.
Right.
So that's there's some interesting.
Yeah, as long as you don't raise the rate to go over the high price mortgage limit. Yeah, right now, that until we get April's numbers, that could be a little bit challenging.
Absolutely.
For lenders to do based on all the federal guidelines.
So, in this market right now, Danielle, we're both working with a lot of buyers. What is the advice that we're giving our home buyers there? What are you telling your potential buyers there to so they're not losing faith? How do they compete in this market?
Well, first of all, I tell the clients not to focus on interest rate. Okay. We have no crystal ball. I can't tell you what's going to happen tomorrow. I can only give you some historical perspective of what we've known has happened since January. And we don't know when somebody's going to find a house. So if you're serious about buying a house, keep your head in the game, keep in touch with your loan officer so that you know what the numbers are going to look like. Call your loan officer when you find that house so we can run numbers again to make sure that, yep, you're comfortable and you have the best strategy. The buyers that are not calling their loan officers, I had a situation last weekend where a house in Howell, Michigan went on the market, was listed for $355,000. There were 6 offers on the property and 3 of them were my clients.
Yeah. So
now,
did one of your clients win it?
No, actually, the one that had bid out of the 6 bids, there were 2 highest offers that the seller was negotiating with. My buyer, I had one of my buyers was one of them, and the other offer came in about $10,000 higher, and they just decided to step back and not argue over the house. So, but the only reason that I knew that I had 3 buyers writing on the same house was that the listing agent is somebody I've worked with before. And I had texted her just to confirm my client's pre-approval. And she said, well, what about the other 2? I said, what do you mean, what about the other 2? What about the other 2 buyers that have your name on their pre-approval? And I said, well, I don't even know who that is right now because nobody else called me to tell me that they were writing on this house. So I'm anxious to see where this one went as far as a sales price. But, I look at it and go, those other 2 buyers that are not calling me, in my opinion, I hate to say, are not real serious because they're making emotional decisions based on what they're willing to offer on the house, not based on market conditions and how likely that house is going to sell.
A good sound financial decision instead of emotional. And now when we talk about this this $10,000 difference here, people got to understand, let's not lose the house over the cost of a pizza a month. That $10,000 is about $50 a month to your payment there. And if you wait this out and you wait to the next property in just another month with these appreciation rates, it could go up $5,000, $10,000.
Correct. And in this case, with this particular house in Howell, it was a newer home on 2 acres. I looked at that and went, well, this is going to appraise. I don't think it's going to have a problem appraising, even if it sells higher than asking, because I think it was kind of listed on the low end of where the market was.
What was the asking price on that, Danielle?
$355,000.
Okay, so 300,000 range. So that customer who you've been working with for a year, right, or even the last 3 months, right?
How about
They're
one of the buyers was is 3 years.
3
He's been
years,
looking for a
okay.
house.
But when we compare that same buyer to just 2 months ago on that $300,000 mortgage, now 2 months later, because they may have offered on other homes to say, I'm not paying 5,000 over or 10,000 over. Now their payment's going up 500 a month just because of interest rates. Appreciation probably went up $10,000, $15,000. So they're thousands of dollars in the hole for making emotional decisions, not what is the best financial decision to land me a home and meet my objective and put a roof over my head so I can create wealth through appreciation, create a tax deduction, and get rid of the emotions out of this thing. We're buying stocks here.
In this house, I think it probably sold for about $390 is my guess. But I think it would have appraised all day long. I think $355. I think I would have figured from a listing perspective, it should have probably listed at about $375, and they still would have gotten $390. But the market is going to push the value of the home up to where it should be because buyers that are looking know. Now, here's the interesting thing: of the 3 buyers that I had right on this house, they all had significant down payment, pretty much 20% or more. One of them had a very significant down payment, and you go, you just lost this house over maybe 10 or 20 grand, which, one of my clients has been looking for 3 years. I mean, he could afford more. And in his mind, he doesn't want to spend over $350,
Well, wait a minute. Wait. Put that in perspective. They were asking $350 for the house, right? And it was a 20 grand difference. Well, that's only about 0.6% difference. So they're going to lose the house over a 0.6% of the price?
Right. So I don't know that these buyers know how close they are. And again, the strategy is difficult to embrace, but you have to work the numbers. And one of the clients is putting like a ridiculous amount of money down, like 50% or close to 50%. And you look at that and go, you can afford this all day long. This could have been a $400,000 house and you could still afford it. It's not an issue. And again, if it's not the house of their dreams, whatever, and they don't want to fight for it, that's fine. But there are strategies out there. And for my one client that's been looking for 3 years, he should be looking in a higher price range. Now he's still looking in the same price range. Prices have gone up and rates have gone up. And you go, okay, anytime in the last 3 years, he could have bought if he wanted to be aggressive enough. But
what price range was he looking for? What price range was he looking 3 years ago? How much?
Under 400,000.
Okay, now
he's still under 400,000 3 years later.
Yeah, and now that $400,000 property is $500,000. Wow, interesting. Plus his payment is going to be $500-$600 more dollars. Interesting. Very
so it's just an interesting market, and I get that it's stressful, but when you look at some of these buyers and go, okay, guys, you need to jump into the market, do it well, and I don't get me wrong, I don't want to underplay that this is scary. Okay.
Right. Oh yeah.
But you have to be able to make a decision and move forward. And many times we're not seeing appraisal issues, even with over bids, because there's so many houses selling and they're selling so fast that from the time that you write an offer on a house, order an appraisal a few days later and get an appraiser out there, there's probably been several more homes that have sold that are creating a comparable base to go, okay, this house is now worth this.
Wow. And boy, you made a really good point there, because you and I are having this conversation and it makes sense to us. But these home buyers, they're just home looking on the internet, just going, oh, I'd like that house. But maybe our clients need to actually come in a little bit more face-to-face time and have these hard conversations about getting over the emotional aspect. And let's look at this at a deeper level from a financial perspective and maybe realign their thought process and strategy.
Exactly. And, an interesting thing, and how you equate this to, say, let's say the Florida market, where houses are going up tremendously. But the interesting thing with some of these recreational areas is the money coming in is let's call it older money or seasoned money. Okay. Down here, yes, there's a diverse age group, right? Between the people that live down here full time, the people that come down here for recreational reasons. But you look at this market and where these prices are going. Well, if you have, for instance, somebody coming from the East Coast, New York, for instance, they're in a very high tax state. There are people buying pre-retirement down here or into retirement. This is seasoned money that's coming down. This is not people buying second homes with 10% down, right? They're coming down with large amounts of money. They want what they want at this point in their life, and stuff is selling like hotcakes. But money is coming from all over the country. And in fact, there's even a big European population that vacation down here in Southwest Florida, anywhere from Cape Coral, Fort Myers, all the way down to Naples. So you look at that demand and go, okay, when is that going to slow down?
Right.
Because this is not, this is not what we saw in the early 2000s, where people were qualifying with mortgages with no money down and, no income verification. Here it's seasoned people that are coming down,
Right.
and buying these homes or exiting the high tax states, and this is nationwide news. This is not, Danielle and Vic's hearsay.
Right.
Consumers are leaving high tax states, Illinois, Michigan, New York, Pennsylvania, just to name a few. These states are having a population exodus because of the cost of living there versus other states. And I'm not saying just Florida, Georgia, Alabama's got some beautiful areas, North and South Carolina. There's a lot of great areas in the country where people are going, well, I don't have to shovel it and I don't have to pay taxes on it. So, that's going to take a few years for things to wash through.
And you brought up a point there. Let's go back to the old '09 real estate crash and the Great Recession. Let's remember, people, that housing crash was due to scrupulous lending, and it was also due to there were too many homes on the market, and population growth was going down for the average first-time home buyer. It is not the housing crisis that led us into the recession. It was quite the opposite. It was because there was too many homes and scrupulous lending that led us down that rabbit hole. Where in this time, we just don't have enough properties out there, so we don't see any housing bubble coming anytime soon. I believe, and I guess I'll put this on record, I see 5 good years before we start seeing indication of turning more towards a neutral market, I guess we could call it.
A more balanced market, yeah, but that's based on the size of the millennials.
Yeah.
The millennials, the youngest millennial right now is about 24 years old. Again, we've talked about this in other episodes. If the average age of the first-time home buyer is 31 to 33, we do have a 4 or 5 year cycle to get all of those millennials to their early 30s. And even after the millennials hit that age group, the Gen Zs are coming and they're almost as big as the millennials. So will things level out in about 4 or 5 years with real estate? Yes, I think that would be the case, but there's still going to be a strong need because the next generation is also pretty robust.
Absolutely. Hey, you talked about people moving to Florida, the people with old money. Let's talk about the population that now that the pandemic has brought Zoom and working from home, people can see themselves, hey, I can work from anywhere. Ooh, Florida sounds good. Are you seeing any of that down there?
Oh, I think absolutely. Absolutely. So we met a couple yesterday that live in Maine. They have their own company, and it's a small family company. Their son and daughter work in it, but they do come down now and just built a beautiful home. And they've been down here for years, so they're actually on their 3rd Florida home. They can come down, and the family's running the business. I've been working since I'm down here. It's not quite like being in the office, but I'm still taking calls and interacting with my customers, and I can do that without a problem as long as I'm in a place with good internet. So that's one of the reasons why we prefer to rent houses, because we have space. It's very comfortable. I've got great internet and a pool right in my backyard. So, I can leave my computer on the lanai and.
Hey, I've got a question for you on this build job you're doing, right? And I'm just thinking this subconsciously. So once you get all your builder quotes and that, and you get under contract, those numbers are pretty solid then through the build?
Well, that's a great question.
Okay.
Most of the builders right now do have escalation clauses in their contract,
Okay. So the
which
cost
means that
plus.
if something happens during the time that we come up with a price and we start building, for instance, let's say concrete skyrockets,
Right.
they have the ability to come back to us and adjust the price of the house, but they
So
would
let,
have to document for us what happened.
okay, so let me ask you this. So you go under contract, technically you're the owner of the house, once it
Well,
gets
I own
built,
the land. I
right?
own the land, so I am the owner of the property.
And you're doing a construction loan, but let's say you have a total package price. Could you then,
Mhm.
it's going to take 18 months to build, but after, let's say 9 months, 10 months, could you then sell that whole build job and make a profit and walk away?
Mhm.
Yeah. So that's not bad. You played, I'm just going there. I didn't know if you ever
No,
considered.
that so the house that we'll build will be worth more than we're paying for it, based
Uh-huh.
on the acquisition cost of the land and the cost to build. So absolutely, any appreciation that happens over the next 18 months when we're building is our appreciation.
Right. So you could
The
technically,
builders The
you could,
builder can't raise the price of the house
right.
because he wants to. He could only come back to us and say, hey, there's a problem and you got to pay for this.
Okay, but
But
you could technically, after 1 year of that 18-month build job, you could technically sell me the house at a huge profit, and I just wait for it to
yeah,
get done.
exactly, at market value. Yeah. Well, I don't think you'd sell it until it was done. You wouldn't
Oh,
want to sell it legal standpoint until we had a C of O on the house.
right, right.
But
But
yes, there are people, believe it or not, that do that down here.
wow, wow.
That will build a house, wait the whole time. And, because again, most builders aren't building what we would call a spec home or a speculation home. They're
Uh-huh.
not building a house. There's a little bit of that down here, but most builders will not, go out and build 5 houses and hope that somebody buys them.
Well, now
Sometimes they'll start one and try to sell it before all the finished selections are made.
now let me ask you this: are you seeing just these big, huge builders, or do you see any mom and pop shop builders out there?
Most of what's in Cape Coral is, I would call them mom and pop shops. I mean, there's some of them that have been around for 20 and 30 years, but Cape Coral itself does not build like a subdivision where one builder builds all the
Uh-huh.
houses. They're all individual lots. There's about, I don't know, 25, 30 builders in this area to
Okay.
consider, of all different price points, from a very basic, nice home all the way up till palatial, $1 million homes that they put on bigger lots and on the water and stuff like that.
Interesting. Very interesting. Well, this has been a pretty interesting episode. What last
Mhm.
words do you have for our clients who are still looking to buy here in Michigan or look to buy or build in Florida?
So we are licensed in many states. I think with just our team of loan officers, we're licensed in 5 or 7 states right now. I won't
Uh-huh.
even be able to name them all at the top of my head because I know that a couple of our loan officers are working on new areas because of where their connections are and where their referral base comes from. So if you're thinking about a second home, give us a call. We'd be happy to go over your specific financial situation and come up with a great game plan for you. And honestly, I also tell people, if you're pre-retirement and you're thinking about buying a second home out of state, eventually making it your primary residence, it's a really good time to do that before you retire. Most people don't understand that, your income is going to change when you retire,
Good
and
point.
you might be in a stronger position now to buy and then get your place set up and then worry about maybe selling your Michigan home later. So give us a call on that. And if you are in the market to buy a first home or a move up home and you need help with strategies, please give us a call. You really need to make some strong financial decisions based on market conditions and what your goals are for your family, before you try to enter this market and get into multiple bid situation.
Well, that is words of wisdom because you've always told me, Danielle, leave your ego at the door. So, customers, let's leave our egos at the door. Let's talk good, sound financial strategies. Take the emotions out of it. That was Mrs. Danielle Boote from Florida. My name is Victor Bals, and we will see you next time on A Smarter Way Home.
Try